So to Foliko Live, I am Travis Nixon, joined by Tyler Tucci. It is July 19th, 2022, and we're here to give you stocks to watch for today. Today is going to be a focus on earnings. Now, remember what we're doing. We have an artificial intelligence powered engine that goes out and reads all the world's news articles, collects it using the latest NLP AI algorithms, and makes opinions and views on the current and future states of companies. Now, today, what we're doing is we're using those models specifically to predict earnings per share. And then we take that, we compare that with the street, and we benchmark whether or not we're above, so beating the street's consensus expectations for earnings per share, or we're projecting a miss. And using that, we're going to then put in some trades and make a determination whether or not this is a good opportunity on the long or the short side. So, Tyler, thank you very much for joining. What do we have for today?
We have some actually kind of a mixed bag. We have some credit cards, some pizza, and some tractors that we're gonna talk about as it pertains to earnings for Thursday and Friday this week.
This sounds like a John Candy movie.
A bit. I hope so. They're all awesome. Hopefully these will be too.
Let's do it. All right. So what do we got?
If you will share my spreadsheet. So this is the whole earnings picture as predicted by our data for this week. And what I have is, if you see in column J, for our favorite trades of the week, I am showing the price of the option and the break-even move necessary for the at-the-money option, just one leg. To be clear again, this is not the straddle. We are making directional bets here. We don't need both at-the-money legs. We just need one.
Do you mind zooming in a little bit? It's tougher to see on the screen for this one. Perfect. That's great.
Cool. And I had some questions about, why do I always use at-the-money on this show, and is that how I trade? The answer is no. But we are making time-based price forecasts. So in order to benchmark how our calls are doing, because it's not just good enough to be right in the right direction, we have to be right within the period we called for. So that's why I like using the at-the-money option, because it is the time-based price prediction market. And that's what we're doing. We're making time-based price predictions. So this is my proxy to show how we did both directionally and against market expectations.
All right. So as we digest, this is a ton of tickers, Tyler. I want to make one quick call out. So we have Twitter earnings coming out, right? And we actually are projecting a beat for Twitter earnings. And yet that's not one of the ones we're going to highlight today. Twitter has been talked about so much lately. I want to touch on why we're staying away from this. You should know why we're staying away from this. There's currently caught in litigation with Elon Musk on a potential purchase. This company has been focused on everything but making money. The algorithms for moderating the conversations on Twitter have completely gone awry. And so there's been a huge inflood of new users from one end of a political spectrum in the United States, whereas an exit from the other end, right? So is this going to translate to earnings beat? They could beat earnings. Here's my biggest point. They could beat earnings and you'll still have no idea what the stock price is going to do. And I think that it hinges entirely on the relationship between Elon Musk and this company. It has nothing to do with the financial performance of the company right now, which is why I wouldn't touch that company with a 10-foot pole, even if we're confident that the earnings are going to be better than people think.
And to be clear, we do. We have them being, despite being allergic to prosperity, we have them, being having positive, profitable somehow, right? So,
the thought has always been the short-term profit's going to come in when you unleash the algorithms and you let everyone pile in. But the mid to long-term health of the company deteriorates once the conversation turns into mudslinging all day long. It just can't survive for long like that. And it's the MySpace experiment. MySpace did really well on everything is free, right? It's your space. You can do whatever you want with it. Facebook thrived on moderating. And I think that's how social media does best. So, no, I don't think that this portends to long-term health of Twitter. We'll have to see.
And if you'll share my other screen share here on Twitter, just the Foliko, view of this, gross. In one word, no thank you in 2 words, 3 words. But that's just nothing good here, right? Earnings power after having been at the max value is recycled not just to zero, to a Z-score of below 0 now.
Mhm.
With management in a free fall, reputation literally can't get any worse. Systemic turning down. So, pass to be nice on this one. But, we do, for our own testing purposes and monitoring purposes, it is interesting that despite all of this, our EPS is actually positive for this quarter.
Yep. And so, look, if you want to make bets on Twitter, make bets on what the litigation will do and then how the stock price reacts therefrom, right? So, if and what an interesting battle that is. Just to say, this has got to be like a market unique event, a unicorn event of a company is doing everything it can to force someone to buy it. Like that's just kind of a hilarious situation, right? Um, we'll see what happens. All right. So back to the rest of these tickers. What are we seeing that's really interesting? We had some call outs from Eduardo Pereira yesterday on Pizza Hut. So we had some teasers on that yesterday. What are we seeing today?
So let's talk about it. So I'll
Sorry,
show
not Pizza
that.
Hut, Domino's.
Yes, this is Domino's Pizza. So we have the at the money option is about, call it 975 mid right now. That implies about a 3.5% move down. Our earnings model is calling for a miss, and if I can bring you over here, that's not good. We think, according to Foliko, the prime earnings and pricing power for these kind of companies is behind us, which makes sense. I mean, Domino's is certainly something you're ordering more when you're trapped inside your house as opposed to when you have literally any other choice. So we kind of think that the recent squeeze from 350 to 400, definitely not founded by an increase in earnings power or earnings expectations. We think this one's going to be kind of nasty. We don't think the market's, really looking for this. So, we expect it to cover the almost 4% implied spread down. We'd be comfortable buying the at the money put at 975. As I said before, I'm not trading at the money puts on all of these, but I'm just trying to show how our calls either outperform market expectations or didn't. And I think this is the best way to measure that. So, short DPZ into earnings, we're looking for a nasty print and some follow through lower.
The other call out I'm going to make on them is, have you noticed they've been riding this everything is $5 wave for years, like the medium pizza, 2 topping, $5, right? And you can throw in a brownie and a salad and a pasta or something like that, which, it's all terrible. But they can't keep up with that. The pricing pressure is forcing them to move beyond that. And we saw this happen with Subway, the same exact effect of as soon as Subway had to start ditching its $5 foot long days and things like that, and they had to start get creative with those prices because you just can't keep that up forever. It did hurt sales. It's so comfortable. People get used to thinking it's a value for $5. I can get this much food. And then once you start betraying that customer trust, you have to reset with another successful campaign. So it's going to take some marketing intelligence and innovation for them to land back in that soft spot and reestablish that relationship with customers. And for that reason, I think they've got some pain for this earnings round coming up.
Right. Arizona iced tea, they are not. They will not be holding prices firm at 99 cents, But yeah, all the ingredients costs have gof up. And I think
gas to deliver the pizza. Have you noticed they're doing extra charges for delivery now?
Yes, right. So all of the inputs are up. Just in terms of the best, the best growth opportunity set that was behind us during COVID. People, now that they can leave the house, it's Domino's isn't the only game in town anymore. Yep. So, we're looking at this one, to head lower.
Cool. All right. What next?
So on the other side of pizza, we have cigarettes. So, I guess this makes sense. Recession, everyone's losing their job. We're all chain smoking. But this is a pretty massive bullish divergence here. Kind of similar to Allied, except our earnings model also has a pretty tidy beat here too. So we have a massive bullish divergence and a beat on another model. This is probably, if I had to just pick one, this is my favorite trade of the week.
And it's a significant beat. I mean, we're projecting a beat in earnings of, what is that? That's about 20%, right? Now, remember, when we project a certain percentage beat, what we're belying is confidence. We care about the sign, right? We care that this is going to exceed expectations and therefore translate into an appreciation in the stock price, right? But when I see a 20% beat like that, I'm seeing something that we have a little bit more confidence in the model.
Right. And I mean, even more confidence in Foliko. I mean, that's a pretty big divergence there. The at the money calls are only $1.75. That's about a 2% move higher. Gosh, we have to imagine that it'll have no problem covering that spread, given, not to use the term max bullish, but pretty close. Everything in agreement and everything in pretty big agreement. So I definitely think this is, of all of our ideas for this week, probably if I had to have two, it would be probably long Philip Morris and short Domino's, or the J&J call we made yesterday.
Now, they're not getting caught up in the e-cigarette bans, are they?
A little bit. And so there's a couple things here. So yeah, but are they ever going to go away? Are people who are users of this stuff ever going to get cut off? No, they're just going to make it harder for the future generations. Are going to hike the age from 18 to 21, things like this. And it's also, to my understanding, that while these companies, the Altrias, the Philip Morrises, don't have a ton of cannabis exposure at the moment, they are all preparing, the minute it becomes federally legal in the US, whether that's 1, 5, or 10 years, we can debate, they are all ready to jump in. So I do think that is especially given the prices of stocks in the cannabis sector in general, it's kind of an underappreciated feature you might be getting for cheap at the moment. But I do think that is one route is that they start to diversify, and they already have, away from just Joe Camel and the old just cigarettes and cigarettes alone. Now it's a bit more of a, I guess I'll call it a product mix, but with some potential for growth. So
well,
we're not buying this for an investment, but I definitely do like this very much for a trade.
And one quick note. So there's some bans coming in on e-cigarettes being marketed, especially to minors. I think there's a lawsuit going on that's really heavily hitting Juul, and Altria is the owner of Juul. And so I want to contrast what we just saw with Philip Morris and why this looks like such a good pick this week by contrasting this directly with Altria. You can see once that litigation starts coming in, their stock price just absolutely plummets. And I think Philip Morris got caught in a lot of that anti-halo effect, right? But what we see conversely with Altria is their earnings power in the past few weeks just really not doing well, just suffering and doing a sympathetic loss in that stock price at the same time. So I think in contrast, Philip Morris probably a little bit more protected from Altria. I like that trade, Tyler. I like it quite a bit.
And we like to see the differentiation, right? Like if we had come here and Altria earnings power looked like Philip Morris Health earnings power, I would have been less excited. But the fact we do actually have, a pretty big difference between the two, and it's not just like, we didn't accidentally pick up some correlation of, and it's just, correlated, right? Like we actually have a distinction, which actually, adds to my bullishness. I hadn't seen that, until just now, but that I think is another tick in the bull camp for sure.
Well, and I think that there's a whole bunch of stocks that for ESG purposes, people just left behind in total. Like they said, I'm quitting this stock forever. That's the story of the energy sector where, oil's dead, always will be. Look at Tesla. It did away with oil. And then all of a sudden for the past year, we've all been going as hard towards oil as we possibly could. It was the refuge asset to weather the storm for the past little while. Only recently did it start backing down and stuff like that. I think that cigarettes and tobacco are a similar thing. Look, I don't smoke myself. I think it's an unhealthy habit. I help you if you can get over it. That's awesome. But at the same time, I think that this is a company that people have the right to choose to purchase these products and to enjoy them. and it's not going away. And I think that people possibly have under or oversold this industry right now. And there was excitement around e-cigarettes and stuff like that. That's going away, but tobacco is still going to hang around probably as long as I'm alive.
It's a safe bet. I mean, it's been around just as long, so we can assume it'll be, that long into the future usually, right? So, it's not something that's going away. There are different iterations of it in the future. And we're talking about a long-term bull case, by the way, you and I, but, what our view is here is, decent earnings beat and snap higher in price on the discrete event.
Absolutely. Absolutely. All right. So, and then I see one more here. I'll pull up your screen again, Tyler. So if we're looking at that last one.
So this one's kind of secondary. We definitely have no move higher in earnings power, with a squeeze higher in price. And we have a pretty decent miss on our model as well. So, this is more of a combined view where everything paints the whole picture and, we're comfortable with the trade. The downside on the at the money put is about 3%. It's about $6. That one, there's two reasons why we kind of push that to a tier B trade. One, I don't necessarily know if, the earnings set we have is, can we do -10? Of course you can, but it's not, the base case for Philip Morris would be a large move. The base case for Tesco would be kind of a medium-sized move lower. So do I think it can beat that the -3%, let's call it forward? Yeah, I do. But it might be 3.5% or 4%, which would be less exciting than, if I think Philip Morris could be plus, 7 or 8, right? So that would be, in terms of ranking, I certainly would rank it lower than, the J&J short or the Domino short or things like this. But it's definitely something that, we want to bring attention to, ourselves, because we like to review literally every divergence and look at the performance of that as its own, if that was its own strategy. So, that's something we will always bring to your attention, because we're looking at it as well. So Tesco lower, on earnings would make some sense to us.
And why lower Tractor makes sense to me. Look, you gotta leave Tractor out of the name here. A lot of their boom over the past few years has been the strength of people moving rural during COVID and outfitting their houses with a lot of rural consumer goods, the more rural type couch, the more rural supplies that you would put in that house once you have a little bit more land and stuff like that. They've done very well making a strong market out of that. Reselling, or that they sell through Walmart and a lot of those front-facing consumer retail stores and things like that. And just with the consumer slowing down and the trend kind of exhausting itself to go more rural as the housing market slows down, this is going to lead to some friction in their earnings coming out in this quarter and going forward. So even if it's not the weakest quarter that they're going to see, I would very, very much not be surprised for weak guidance going forward, leading to a depreciation in the stock price further. And so it makes a lot of sense to me why they would be going down. So what else should we be looking for, Tyler? So if we have our 3 discrete for Thursday,
do you want to move to Friday?
PM, DPZ, what do we have for Friday?
So let's see if I can.
Here, I can pull up my screen for the sheet if you want to see it.
Perfect. Okay, so so there we go. So really, we had 2 bull signals that I am going to say, only one is valid. Because so we have a pretty tidy beat in American Express. It kind of would make sense in our, banks might have bottomed last week thesis, that we would try along here, especially with agreeing signals from both Foliko and the model. If you would share my new screen.
Yep.
So, that's a nice lead higher in earnings power. It's a nice gentle slope. It's a nice turn. So we're expecting some upside there, especially because the break-even move is only 2.5% higher. Given the move we had recently, I don't think there would be much issue, clawing back a bit more than that. especially given our EPS, view, which is also, pretty bullish. But again, I would classify this as a tier 2 trade, more a la Tractor Supply than, Philip Morris, Domino's, J&J, things like that.
So what we're seeing here, if I understand you correctly, is that the earnings power has really started leveling off somewhere around earlier July. The price has stayed unchanged since then. And because of that, we do see a pivot point to go a little bit higher. Is that right?
Right. And I mean, if they were about to report, nasty recessionary numbers, which is weird because, the bank suggested that the consumer was levering up. So, maybe that's what we're catching here. But, I would expect all of those indicators to be falling off a cliff if, they were about to report some recessionary starving consumer numbers. So, we think that potentially sets up for a nice trade higher, but it is a tier 2 trade. The divergence just isn't as big as some of the other ones. And what we've observed is the larger the spread, the more significant the move and the higher probability that we get a move is. So, we want to be focusing there.
That makes sense. And finally, I see one more here, HCA. What do we have going for there? Because here we have mixed signals on Foliko versus the model.
So this is it's just as important to know when not to swing as when to swing. So the reason we're gonna take this pitch here is even though we have something of a bullish divergence here, we have a horrific earnings report or EPS forecast. Like we have, this is one of our largest misses in a sector that we don't think is, going to be the one to own, healthcare. So this is one we're going to stay away from, even though on a one factor screen, it did show some earnings strength, but I think there are so many other mitigating factors that, we'll just leave this one alone.
Interesting. So while we do see some factors in Foliko that would say buy, everything come together, you're actually taking that off the table.
Yeah, I mean, like I said, there's 252 trading days a year. You need a reason to trade, not a reason not to trade. This is, I see no reason to trade here. So, we can leave that alone, especially given we got plenty of other signals this week.
Fair enough. All right, that sounds good. Well, Tyler, that about wraps us up for today. Any last thoughts before we go into this? Signals, in, out, timing, anything like that we need to note to our listeners?
No, I mean, I think, we're gonna evaluate this week, and then we really start to get to the heart of the order in terms of earnings. Some of the FANG stocks, some of the ones that are really, really going to impact the prevailing move of the indices in the market for the next quarter, or at least quarter or two ahead.
Cool. All right, everybody, thank you for joining us this morning. We're going to get to trading, but first I want to preview tomorrow. We're going to be talking about ARK. We previewed this a little bit last week. We see some interesting signals in our data that show that ARK may be ready to purchase here in the near term. So let's take a deep dive look. In essence, what we're going to be talking about is innovation. And I think that this cues us up for the next decade of investing. So this conversation is going to be very important. ARK itself doesn't matter so much. What really matters is where we see growth coming and where we see that pipeline of innovation coming out to drive returns over the coming years. So don't miss out. Join us tomorrow, 8:30 a.m. EST for Foliko Live. Thank you, everyone, for joining, and we'll see you tomorrow.